always a question about, hey, what factors should somebody consider before deciding if they should sort of invest in an RRSP or TFSA, in your opinion?
The RRSP and TFSA both have tax elements, some tax reliefs. And the first one has more tax reliefs. RRSPs have more tax reliefs than the TFSA. So let me start with TFSA because to me that's the least important aspect or inducement for people to save money. That where when you put the money in there, there's no restriction. I mean, you have amounts given each year, $6,500 to $7,000, and it started recently, and so I think going back into 2009, I believe, and then accumulated. If you haven't used it, you have the room available. So when you contribute money, it has to come out of your after tax money. So you had to pay tax, and you need to have the money to contribute, and nobody gives you the CRA won't. You don't get any tax benefit by contributing. The benefit that you get is when that grows, let's say you grows in interest income or any kind of income that develops within the TFSA, it's not taxed. And then when you take out, so you can take it out, there's no taxes too. Goes in without tax, earns tax-free, but when you take it out, no taxes. So that compares to RRSP has a very, very unique situation where when you put aside some money, and 50% is contributed in the form of tax incentive, no taxes paid. So it's huge, its amount is large. Then it also grows without tax implication. On a compound basis, imagine that it grows without taxation to a certain percentage, there's no tax, and it grows, the whole thing grows again. So year after year after year, it's compounded. People don't realize how much of, with some decent growth, if they put it into a decent fund with the no taxes being levied, and that multiple effect, the compounding effect is so huge, and end of the day it grows faster and faster. So you have to put that into early in years age, and you will receive a larger benefit. The growth will be multiplied because of the tax incentive.
Right. So I think it's really making sure, having a holistic picture as to what you're trying to accomplish should probably drive between, hey, should it be an RRSP or a TFSA at the end of the day, right? Some of the soft examples are, for example, a TFSA is very flexible in the sense that you can withdraw the funds at any point in time. Correct. Yes, RRSP can also happen. I mean, ideally, it's meant to obviously save for retirement. It's there, and there are tax implications when you withdraw versus in TFSA. You don't necessarily have that, tax implication when you withdraw the funds, whereas both of them actually grow on a tax-deferred basis anyways at the end of the day. Right. But on the front end of it, RRSP, you do get the deduction, whereas at TFSA, you're not necessarily getting a deduction, for that contribution. That being said, if you are in a lower income tax bracket where your deduction isn't going to necessarily earn the biggest return from a tax incentive perspective, TFSA may be another option that could be utilized at the end of the day. Go ahead.
There is another point I can connect. Remember that you asked me about earlier, the withdrawal of RRSP will have some impairment, some consequence in your retirement age. Here's the solution. So if you're withdrawing from your TFSA during your retirement, there's no tax implication.
And that's always important to know because, for example, depending on what type of income you're at or what kind of employment you're at, it's not easy. It's not too hard to rack up your income during retirement as well. For example, if you're in a defined benefit pension plan, which we don't really see a lot nowadays anyways, but a lot of staff at the major banks or a lot of teachers, for example, from what I've heard, have defined benefit pension plan. And if you're earning a decent income through your defined benefit plan, and you're going to be, let's say, having CPPOS coming your way, and if you're going to be, withdrawing some funds from your RIF, it's not that hard for you to rack up your income bracket at a $90,000, $100,000 tax bracket. And if the RRSP doesn't necessarily justify that from that perspective, it's worth considering. So for example, at retirement, if you're going to be in a significantly large tax bracket, it's worth considering to see if RRSP can be, or if TFSA can be used to complement that, rather than RRSP, just because we want to make sure we're sort of considering everything from a holistic perspective at the end of the day.
Right. So that kicks in, TFSA kicks in if you have used all. There are clients, they have used up all the RRSP rooms. There's no room, but they have excess cash. So it's leaving, as opposed to leaving the cash outside, leave it into TFSA. There's no tax implication. So you can grow that money tax-free.
Absolutely. So it's always worthwhile making sure we consider, hey, let's maximize registered investments first from a tax perspective to be able to grow tax deferred investments before we sort of explore some of the non-registered investments from that perspective. Val, what about for business owners? I know I get this quite a bit. I mean, if I'm a business owner, I'm not necessarily always taking a lot of income out because a lot of the expenses are done through the business. At the end of the day, I'm taking a very nominal salary per se, and then I may not necessarily be earning a lot of income from a T4 income from the business. What are my options? Should I be considering RRSPs? What sort of holistic factors do we look at before deciding? I know we have a few solutions that are catered toward the business owners, but before we jump into that, what would you sort of say from a tax perspective that should be considered?
Right. So the business owners, I have seen the business owners drawing only dividend, which I consider is a no-no situation because it doesn't create your earned income. So as opposed to salary, bonus, that's an earned income that creates RRSP room. So that leaves them with no room. So there are owners only taking dividends. So, and then that's one thing. Recently, CRA pronouncements came. You should take your salary before you take your dividend. And if you are involved in a business, because you are working there, so where is your salary? So that's the question comes in before, instead of seeing a dividend. So they recommend salary first before you take your dividends. Dividend is somebody invest and stay away and it gives you a dividend, stay away from the business. But when you are involved in the business and you are working, you are contributing, there should be a salary. So that helps in few ways, that take your salary, that helps you to, that gives you a CPP. You don't have to pay EI, employment insurance, because you are a business owner. But you will set aside contribution, Canada pension plan, at least to the max of the maximum amount. It's in, I believe it's in 60 grand area now. So you set aside that take that much of money. So the company contributes and company deducts, and you deduct, you pay for that too, and that become a solid investment. You will get Canada pension.
Okay.
So that's one thing. So in the process of getting the pension, and you also create a room for your RRSPs and earned income, and then put aside some RRSP. So my recommendation for the homeowners, as long as you have income in the business and you start drawing some salaries and create room for contribution room for RRSP, put aside contribution for CPP, so you are winning at two ends, and the remainder, then at the high level, you could start drawing dividends to for the tax planning. So dividend doesn't serve any purpose at the lower level, lower income.
Got it. And just so that we can summarize it, Val, at the end of the day, it's always a good practice, from what I'm understanding, it's always a good practice to be able to declare a set amount of salary, which is going to be able to help open up, some RRSP contribution rooms, CPP, old age, OAS, all of that kind of stuff will sort of be there sort of in the back end in terms of benefits, because naturally business owners are sort of known to sort of, not, draw a lot of salary, draw a lot of dividend, but that doesn't necessarily help you sort of establish, RRSP contribution room at the end of the day. Mm-hmm. That being said, I know there are, for example, programs, which we'll sort of maybe explore a little deeper in some of the next segments, which is individual pension plans or retirement compensation agreements, which business owners will have, that where we can fund through the businesses an individual pension plan for business owners at the end of the day, which we're not going to get into deeper in today's conversations, but that's really from that perspective. Business owners do have that option to be able to explore and invest through individual pension plan as well as retirement compensation agreements, and fund your retirement through the businesses. But from a salary perspective, unless you actually declare some type of salary, you're not going to be able to claim sort of CPP or OAS or even the RRSP contribution rule.
Right. Yeah. Not OAS, CPP and your
RRSP contribution.
contribution.
Perfect. Val, something I'm also now looking at, hey, I'm in the back end of it. I'm going to be able to withdraw funds. I'm in my RRSPs. A couple of things that sort of comes to my mind, right? I know we talked about some of the potential factors that we need to consider, like, hey, am I going to be in a higher income tax bracket when I sort of withdraw the funds as a consequences of pension or government benefits? Am I sort of going to be, how's my overall income going to look? Because even rental income, for example, can impact what tax bracket you're in, and which may sort of obviously trigger a higher marginal tax bracket when you're sort of on the receiving end of your RRSPs. But one thing that comes to my mind is, what if I'm actually no longer living in Canada? And let's say if I'm living in a country which may or may not have a tax treaty with Canada when it comes to sort of foreign income at the end of the day, right? Would there be any type of impact, or do we need to sort of consider, is there going to be any type of double taxation? Just because if I live in a country that doesn't necessarily have a tax treaty with Canada, how would we sort of consider some of those factors?
Let's begin with an assumption there is a tax treaty. So there is only a few countries that you don't have tax treaty with. So the income that earned in Canada, you have to pay whatever the income you earn, whether it's in the form of a RRSP RIF income or your old age security income or CPP. And you have to understand, old age security income will come to a stop if you stay over 6 months. So, but you can earn those income. Whatever the income you earn on Canadian soil is taxable in Canada. That's rule number one. So then after taxing, if you are living in another country and you are a resident of that country, that becomes taxable there. So usually a lot of people here in Canada are resident in the US and they take all this income, and when they go to pay the income, the taxes in US, they have a double, treaty arrangement between these two countries. So it's not taxable in the US and it is not taxable in most of the countries. So the impact is pretty less. So they need to take this money plus this money and then income and combine the income and pay the taxes, and they will get credit for the taxes they paid in Canada. So that's number one. But if you have to understand, whatever the income you are paying, you are receiving in Canada is taxable first hand in Canada. So you need to pay taxes. You may have to submit your tax returns, and then you can use the tax return going forward to file your country where you are resident. So if you retire and go in and in retirement age you relocate to another country, you need to consider this.
Yeah, and it's just from a planning perspective, I think the most important thing is, while you're contributing towards the RRSP, it's important to consider what retirement will look like. And that just for planners like us, just to make sure that, hey, let's actually look at what does clients' retirement look like. Are they going to be living here? Are they going to be living out of the country? What is their income levels going to look like? Because without considering those, we shouldn't necessarily jump to the conclusion that RRSP is the only solution that'll essentially be from a retirement perspective or from a tax perspective. Of course, it's probably a solution for most people, but we should always be considerate or careful with the fact that, hey, where are we going to be living? Because the tax treaties where if Canada has a tax treaty with or if Canada doesn't have a tax treaty with a country wherein I might be living there in retirement, there's a potential chance that I might actually get taxed on in both countries, and there might be double taxation issues if there's no tax treaties in Canada.
Yeah, that's true. And alternatively, don't go to a country which doesn't have
a tax treaty with Canada. Absolutely.
Canada.
And Val, so as we sort of come to sort of maybe the latter end of the chat, a couple of things comes to my mind. I'm actually dealing with this particular issue. Unfortunately, it's an estate that we're working with, and they had close to about $500,000 of RRSPs, within the file, and unfortunately, it's the death of the second spouse. I mean, there's no spousal rollovers happening or anything like that at this point. As you can imagine, there's a huge tax bill that I'm working with, and luckily enough, there's a few solutions in play. But one thing to always consider at the end of the day is, how does taxation work for example, at time of death, and if there's a large RRSPs. And maybe this is why the CRA has a stipulation which says at age 71, start withdrawing the funds and start paying some taxes towards these income rather than sort of accumulating as a whole, because the reality is that RRSPs are 100% taxable at, let's say, at the time of second death, for example, right? Can you maybe elaborate on what happens usually at the time of first death? How does the spousal rollover potentially works for RRSPs? And then how does it actually happens at the time of second death of both spouses?
Yeah. So, firstly, initially, the spousal rollover is that's available mechanism for RRSP and not for RIF, not retirement income fund. So once you reach the stages, you cannot roll over that. So that's number one. The second thing is if both spouse died and there are income in there. So once it's rolled over means one spouse dies and then the fund can be rolled over to the other living spouse tax free. So then whenever she takes the money in whatever the form is taxable. So which is a comfortable situation. She is left with large amount of money to
Sure.
Enjoy her retirement age. So that's one thing. Unfortunately, things all come to an end. Now it's all done. So that the retirement fund is for a purpose of to ensure good retirement for an individual and ensure comfortable retirement for the spouse. And the individual died, taxpayer died, spouse died. So there is no more purpose. So whoever is becoming a beneficiary to that end up paying the large amount. The estate pays large amount of money.
Yeah. As part of terminal taxes, essentially,
tax.
essentially it is 100% taxable at the end of the day, right?
Yeah,
so,
huge.
and this is where I think just in general, the risk management component of it is super important, because I look at it in two forms. One is sort of, how do you sort of protect that RRSPs while you're alive? So let's take that scenario. It's like, hey, the first thing that I realize is, and I've unfortunately had to experience this firsthand, is I had a client who was going through, a major illness, and what's the first thing that people usually look at? They're looking for reserve funds, and typically it's in an RRSP, and then of course you're going to dip into that reserve fund if you're diagnosed with a major illness or you get into an accident and you don't have any income coming in, and you jump in because there's no other funds available, so you jump into the RRSP. And unfortunately, once you sort of start touching that money, I know you're serving the purpose of that immediate concern, but you're hugely impacting your retirement, everything else that you had in mind for that money at the end of the day, right? So that's while you're alive. The second part of it is, now from a death perspective at the end of the day, whether we like it or not, RRSPs do become 100% taxable. And if we don't necessarily have an estate plan in play, or if we don't find other mechanisms to be able to fund that tax liability, essentially, children's or whoever else is sort of inheriting some of these assets or properties, they're forced to liquidate some of these things in order to pay the estate taxes and the probate fees before they sort of, before they are sort of allowed to enjoy the assets or the things that they built up or their parents may have built up for them, right? So in that sense, I think it's super important to make sure that as we're doing, investment planning, retirement planning, to be able to consider sort of that risk factor, the capital gain implications, the estate part of it, and make sure that we're also planning for that, just so that we can protect everybody involved at the end of the day.
Mm-hmm. Let me touch on multiple fronts. And I had a taxpayer quite a few years ago, and he had some savings, and he withdrew RRSP. He withdrew everything and paid taxes, and he was off to a very prestigious university, and he finished and he paid large amount of taxes, and he didn't have any other saving. Today he's a CEO in a Middle Eastern country,
Right on.
and he makes hundreds of $1,000s. Without that education, there's no lifelong LLP withdrawal. All of them cashed out. He paid that money. Sometimes you had to weigh in your situation. So sometimes you had to collapse your RRSP if you are going to see your returns high in a different form. So these situations are unique situation. In one instance, the taxpayer came and his parent had large $500,000 in RRSP, and he's going through the terminal. So we kind of planned through about 3 years to start taking the money, and it was excess money. He didn't need the money. He started giving while he was alive.
Right.
So giving while you are alive is a pleasure, to your children, to your grandchildren. So you had to, and also you minimize your taxation rather than all up, coming all at a heavy blow to you, to your estate. So you start giving them and put aside those monies, or take the money and put it into RRS at the TFSA to grow. That becomes tax free to you.
Yeah.
So you may have to. The TFSA also could be used to, to equate your income. And if you have to withdraw your money, if you want to still grow that tax free, you can put it in TFSA, and you can later on give it to them. So these are few things you need to look into. These are unique situations.
Yeah, I think every case is case by case scenario.
Case by case scenario.
Val, because one of the things I've always heard is, hey, it's okay to withdraw money from your RRSPs every once in a while.
Definitely.
Maybe you're in between jobs and you're traveling and you may not have any income coming.
Right.
Maybe you're in a super marginal tax bracket or super low marginal tax bracket. So you want to withdraw some funds from RRSP. Is there any scenarios that you've seen where wonky scenarios where give me one example of like it's a perfect time to withdraw the funds?
In one instance, one of the students who was in the chartered accounting professional lost his job, and he was determined to go to school, and he didn't take up any job, and he didn't have any money. So he drew the RRSP and he funded his apartment and all. He said, I don't care, because I want to get the designation. I can make that money. And he said, I'm not going to go starve. I'm not going to go, and there are at the time he had some unemployment insurance, and that's not enough. So he took these monies too and paid for that, and he's a successful CPA right now. So there are times you may have to, supposing you have some desperate need for them, and who am I to say that don't take it? So this is primarily meant for your retirement, but if there is a pressing needs arises, that where that current need is much important than your retirement, I would say go take it.
All right, well, so just as we sort of bring the close to the conversation today, just wanted to quickly summarize and touch base on a few points that we sort of talked about today, right? First of all, why RRSP? And when we talk about RRSP, we're talking about a few benefits that sort of come our way. It was implemented so that Canadians are able to save towards their retirement and make sure that they can sort of enjoy that retirement in the same way it's sort of forcing them to save it, but in order to force them to save it, at least giving them a tax benefit or a tax incentive to be able to do that, right? So first things first, when you contribute towards an RRSP, you are getting an immediate tax benefit by virtue of getting a tax deduction from your taxable income. Second thing is, in addition to getting an immediate tax benefit, your growth within the RRSP also is growing on a tax deferred basis at the end of the day. So you're not paying taxes on a yearly basis for the growth, which otherwise would have reduced your growth rate of or the speed of your growth on a yearly basis. This makes sure you're accelerating that without any tax implications on the growth of your RRSP at the end of the day. And of course, the third part of it is, now that funds are being grown on a tax deferred basis, at one point or the other, you do have to pay taxes. So when you're withdrawing the funds from the RRSP, you do pay taxes, but the hope is that you're in a significantly lower marginal tax bracket rather than being in a higher tax bracket when you initially got the tax break, sort of balancing out and actually widening the gap so that you're paying the taxes at a much lower bracket versus the income when you earned it when you were in a much larger tax bracket. So that's sort of the notion. So you're getting an immediate tax deduction, you're growing the funds on a tax deferred basis. When you're withdrawing the funds and using it for your retirement, you're obviously in a much lower tax bracket, or at least that's the hope for it. We also talked about some of the implications that we need to look at when you're withdrawing the funds. For example, things like pension income or rental income. Anything else that's going to increase your marginal tax rate has to be considered when we are sort of investing into the RRSP. If you're going to have a significantly large, whether it be estate or whether it be other properties and values that's going to sort of gear up your personal taxes at retirement, and which if you are going to be in a marginal tax rate that's going to be significantly higher than when you actually contribute them, you might want to see if RRSP is actually worthwhile for you. That's the first part of it. The second part of it is, for some people, if they're in a moderate level of income, for example, let's say, which is very subjective, but let's say $50,000 or less, for example, is it going to be worthwhile investing in the RRSP? it can be questionable at times, just because the difference or the tax benefit that you'll see with the refund may not justify investing into RRSP for some people, where other people might say, hey, let the contribution room grow as we're in the lower income per se, and when you're in a significantly higher tax bracket, maybe invested in the RRSP during those times. Of course, you have to sort of be careful with it, because you're missing out on the compounding part of life per se at the end of the day, of the RRSP growing at a much larger pace. But if it's going to give you a tax bracket that's significantly larger to contribute it when you're in a higher tax bracket, you might want to consider those aspects of it. We also talked about sort of different investment strategies. Is RRSP the right one for everybody? Maybe, maybe not. For some people, TFSA might be a better strategy than an RRSP, or for some people like business owners, we talked about why or why not RRSP would or would not be a good strategy for them. There are other solutions for business owners that might be worthwhile when they can fund their retirement through their business, rather than sort of taking out an income. But we made a point that, hey, in the best interest of sort of society as a whole, it's always important to make sure that we are declaring some type of salary, making sure we are collecting our RRSP contribution room and investing towards RRSP. We are also that way, the business owners are also set up for their CPPs at the end of the day as well, right? So considering that holistic approach per se. Then we sort of talked about some of the programs that are available for them, from first-time home buyers program or the lifelong learning program, in which cases, there's no tax consequences of withdrawing the funds, because it's actually being used for either purchasing a home, purchasing a first home, or being able to, for example, invest towards your education. This way, we are able to make sure we are able to withdraw the funds without paying a lot of taxes for those. That was sort of, the conclusion of how we spoke about, some of the various aspects of it. I know you touch base, right now, just, hey, even there might be pension income adjustments that can come, and sometimes there are pension income splitting strategy that we can potentially talk about. I know we talked about it earlier today off camera, which is sometimes if you miss it, the spousal RRSP part of it at the earlier on, you still have some other strategies that we can sort of employ at the end of the day. And I think for me the most important thing is, we need to understand, as we sort of plan for our RRSPs, it's not just about, hey, let's put in that $5,000 today or $10,000 today just so that we can get a tax bracket, or tax break per se. It's more about, hey, what does retirement look like? What are some of the other investment strategies look like? Let's look at, where might we actually live during retirement? All of that consideration, and what is our retirement lifestyle going to look like? How much income would we need in today's dollars account for inflation during retirement, so that we can actually plan for that retirement on a sound manner at the end of the day, right? So it's important for us to make sure we are considering these impacts while we sort of planning for that retirement, so we can kind of see if RRSP is the right solution, and if so, how much of RRSP should be worthwhile from a tax perspective, etc., right? And last part, I'll sort of end off with this. For me, it's always important to make sure we're protecting that RRSP both while you're alive and also during death at the end of the day, right? From an estate planning perspective. While you're alive, the thing that I want to always protect at the end of the day, there will always be circumstances when you need to withdraw funds from an RRSP. For example, if I'm withdrawing the funds for the purpose of maybe investing towards my home, or investing towards an education, which is going to amplify my retirement and or amplify my income for the future, it might be a worthwhile investment at the end of the day, right? To take the money out, invest it towards my schooling or my home, it might be worthwhile. The part that I want to protect is there are often scenarios which, for example, in case of an accident or in case of an illness, we dip into our savings, which sort of completely destroys what we have in plan for RRSPs. If we are taking out, and in case of a major illness, and we're not getting any income, and we are going into that RRSP to take the money out, it's not that $50,000 we're withdrawing that's being impacted, but it's that $50,000 of growth for the next 10, 20 years that's being impacted at the end of the day, right? All while this is a risk that we could have, simply managed from an insurance planning perspective. So for me, RRSP insurance and considering some of those options that are available for you would always be key while you're alive at the end of the day. And then we also look at it from an estate planning perspective. The reality is that RRSPs are 100% taxable at time of death, and we will at the time of the death of both spouses per se, after rollovers, etc. And we want to be able to plan for those as well from an estate planning perspective. So holistically, we want to make sure we don't look at RRSP just as a vehicle that's a one-time, hey, put it and forget it kind of thing. It's more like, hey, let's look at financial planning as an overall concept. Let's look at where RRSPs, investments, retirement planning, all of that fits in. Aside from or complementary to, cash flow and budgeting planning, risk management planning, retirement planning, estate planning, and tax planning. Let's bring it all together so that that we are able to provide sort of the best practices and best solutions for our clients at the end of the day, right? So as part of that, Val, obviously you've been a tremendous help as always, assisting a lot of WealthBridge clients with, tax planning, consultations and being able to see, ultimately we all want to be able to reduce those taxes as much as possible. So I thank you for providing all your services at all times, and just wanted to let the viewers know that, hey, at any point in time, if anybody has any tax planning questions, they're more than welcome to reach out to us. They're more than welcome to reach out to Val and Val's firm as well at the end of the day.
And let me conclude in 2 sentences, and do not live your life in the fear of income tax, but live your life in the prospect of income.
Amazing. Val, once again, thank you for joining us with our first coffee chat series with Chen. It was amazing just to kind of get different perspectives when it comes to RRSPs and taxes. And team, thank you again, once again, for all of that together. Cheers. And then we'll see you guys very soon with another episode of Chat with Chen with some of the other topics when it comes to financial planning. Thank you.